Welcome to the Value Exchange, everyone. Thank you for joining. I'm Max Wadington, and today our special guest is Jack Neureuter, investor at F Prime, former research analyst with Fidelity Digital Assets. Good to have you back, Jack. Today's topic of discussion is our 2026 look ahead. So we'll get into everything that our team is thinking about going into the next year, and we'll also have Jack add his insights into everything we covered in the report. Just some housekeeping to cover briefly here. The show is recorded today, so you can refer to it later if you'd like. And we'll be doing Q&A at the end, and we'll do our best to answer as many questions as possible. So submit your questions in the chat. As you can see here, the topics covered are pretty wide-ranging, so really anything is on the table. So feel free, whatever question comes to mind, you can use the chat feature in the Zoom. But we won't cover everything today, so if any topic is of particular interest, I would encourage everyone to go to our website at fidelitydigitalassets.com and check out the report themselves. For those of us that are new to Fidelity Digital Assets, we're a subsidiary of Fidelity Investments with a history dating back to 2014. Some folks at the time decided to get hands-on with Bitcoin and actually set up Bitcoin mining operations in 2015. They quickly came to the realization that an institutional-grade custodian was something that the market was lacking at the time. This was essentially the inspiration for creating Fidelity Digital Assets at its start. And since then, really the story has been serving as many of our clients' needs as possible, as well as supporting the broader business for everything they need in the digital asset space. And that's what we plan to continue doing going forward. Jack, welcome back. It's so good to have you back on the research team, if only but for a day. How are you?
Yeah, Max. Great to be on. Pleasure to be here. And maybe for listeners, Max and I catch up, what would you say, monthly? Just to chat about what I'm seeing on the venture side, what Max is paying attention to and hearing from clients on the research side. So this will be business as usual for us, I guess, but hopefully we can provide a little entertainment along the way here.
Yeah, it's always fun for me. I'm hoping to keep this as conversational as we usually do and really also answer as many questions as we can. So again, encourage everyone to submit questions and we'll hit on what we can. Jack, just for our listeners, why don't you give us some of your background, whatever you want to share, and then maybe a little bit about what you do today.
Yeah, I'll keep it brief. Studied finance at econ in college, and you ran into Bitcoin in the digital asset space from a macro lens. I think probably a lot of listeners can relate, and sort of never looked back. Sort of one of those, once you see it, you can't unsee it type of things. Yeah, I think like if you had no context on the history and sort of mechanics and design of today's monetary system, you'd think that it operated a lot more like Bitcoin than it does, sort of the fiat system, for better or for worse. Obviously, there's reasons why it's designed the way it is to create like shock absorbers, etc. But Bitcoin is just so simple and structurally makes sense. And I think if you look at sort of the big picture of monetary and fiscal policy over the past decade, I personally feel like the long-term case for Bitcoin, and then if you sort of open up the aperture wider to just tokenization and blockchain systems, these transparent ledgers to sort of represent asset ownership and increase financial utility of underlying assets, I think the case is sort of stronger than ever on sort of a long-term time horizon. I feel like that's evidenced from seemingly every single week, more institutions sort of piling in with announcements, whether it be to sort of add accessibility to this new emerging asset class for their clients, or to use blockchain systems on the back end to increase operational efficiencies for themselves. But yeah, so for myself, I started at Fidelity on the prime brokerage side for a brief stint. And at the time, there were hedge funds and trading entities. They were trading various crypto funds or assets, and the market in crypto is still relatively inefficient. But at the time, it was even sort of more so, and so there were various like arbitrages for delta neutral trading funds, and I was very interested in crypto, so I was sort of involved in some of that, and then quickly pivoted over to the crypto side, to the research team. Max worked with you on the Fidelity Digital Assets research team for about 3 years, and then finally jumped over to the investment side, where I sit on a venture fund for a firm called F Prime. And so for listeners, F Prime is a venture capital investment shop. We have a number of funds focused across healthcare and the technology space. And the team I sit on is fully dedicated to early stage digital asset businesses. So we invest in equity and tokens, typically seed through Series A, Series B, so earlier stage investments across the digital asset space.
Awesome, Jack. I think that is a reason you provide such a unique and well-rounded perspective. I consider our research team like having a pretty broad coverage, and you'll see we have a lot of different topics to cover today, but personally, I couldn't think of a better person to be doing this with today, honestly. However, I'm going to try to catch you off guard a little bit. Something that maybe wasn't on our look ahead or we didn't touch on too much is the 4-year cycle. I feel like I had to include something on this because our clients in particular, and really just the entire crypto community, as a whole, has been having this discussion for the past several months now, right? And we have our own, I don't think the team is like in consensus by any means, but we have our own thoughts. And I was curious what you think about the 4-year cycle in particular, like going forward.
Yeah. So I can't say I sit here and think about the 4-year cycle a ton in my day to day. But what I will say is like we did make a new all-time high in October of last year. It doesn't feel like it, but Bitcoin did make a new all-time high last year, and then has had this 50% or so drawdown since then. And I think that technically for 4-year cyclers would be in alignment with kind of the timing around when you would have expected a run up and then subsequent decline. And 50%, that is par for the course in Bitcoin of these extreme drawdowns. Now you could argue the top wasn't maybe as euphoric as it has been historically in the past, where you've seen these 3x, 4x, 5x from the prior peak. But also at the same time, maybe that's indicative of the bottom won't be as harsh. And this is a 50% drawdown. Bitcoin has historically had, you can see it in the chart here, 75, 80% drawdowns in some of these cycles. And so maybe there is a bit of a neutralizing like mechanism from the fact that now ETPs exist and there's broader accessibility and people are able to sort of more easily rebalance in and out of these things. And so that tampers down some of the extreme levels of volatility, despite it still being very volatile. Personally, I would say maybe it's a little bit coincidental. I think that Bitcoin's 4-year cycles, like the reason why I think everybody had originally hypothesized the 4-year cycles had existed was the supply schedule during these halvings would get cut in half. And I think that was more relevant when you had higher rates of inflation. But off the top of my head, what is Bitcoin's inflation rate? I believe 2% or below that.
Even less, yeah.
So like the marginal difference from having from 4% to 2%, 2% to 1%, using like round figures here, I think it's less and less relevant versus in the early days. Like if you had a 50% inflation rate or whatever the number was at the time when it had first existed. I mean, technically during the first blocks, you had 100% inflation on the first block, or infinite inflation. And then that since decays over time. So I just think that the issuance schedule is less relevant. But I also think a big part of it is the halving cycles, because Bitcoin was like born out of the financial crisis, have also coincided with these global debt refinancing, like 3 to 4 year cycles. And maybe we'll discuss that at some point here in this conversation. But we're kind of in the midst of another like sort of wave of global debt refinancing. There's so much debt in the system and it gradually matures over time. And you sort of hit these walls of maturity where the debt has to be refinanced. And so it sucks up liquidity from the system. And that means like assets like Bitcoin that trade, somewhat based off of this excess liquidity where people are looking for somewhere to hide out with their capital, get helped when there's more liquidity and less of that refinancing, and maybe get harmed when there's less of that liquidity or some of that debt has to get refinanced and there's like liquidity crunches, so to speak. So maybe there's a little bit of that also happening from a macro backdrop perspective.
See, I never went and thought about the rationale as to why, right? It always struck me as quite a coincidence, especially this last, timing. The previous, like you said, previous peak was in October of this past year. and the last all-time high was in November of 2021. So it's really as close to 4 years as you can get, right? And to many, it probably seems like too perfect to be a coincidence. But, I
Yeah.
think everything you mentioned, I would completely agree with. And I think that in terms of the supply shocks that we're seeing, it's almost a word we don't really hear anymore, right? Because everyone kind of understands how different the supply-demand picture looks like, and everyone's really focusing on the demand side in terms of where price will go, along with the ebbs and flows and liquidity that you've mentioned.
Yeah. So maybe if you made me give a straightforward answer, I would argue 4-year cyclers may be correct for the wrong reasons, and it's not the result of Bitcoin, but rather macro dynamics that happen to also align with the halving schedule. That just you happen to be tightening supply, and it's coalesces around this time where supply in the broader system tightens and weakens. That impacts.
And see, a lot of the arguments I've been hearing we're against the 4-year cycle continuing to play out, and I think there's a lot of valid arguments you can make. And so those people are also maybe right, but just at the wrong time. Like, this was one of the coincidences where it happened to be 4 years, but yes, you might have some really reasonable points as to why it doesn't have to be 4 years going forward. And I think the key takeaway for a lot of our listeners and investors is that volatility piece, right? A lot of the work that Zach on our team has done has really been about explaining the structural decline in volatility over the past cycle in particular, even during unusual times, right? You mentioned kind of we failed to see this euphoric blow off top, at the top of the previous cycle. And I think that knife cuts both ways, right?
Yeah.
So, investors aware of those dynamics could be looking for opportunities to, rebalance over the next bear market, given what we know about the volatility declining over time.
It certainly seems that way.
Yeah. Jack, okay, now we can get into the meat and potatoes of the report. I appreciate you playing ball. Sorry to catch you off guard a little bit there, but we can talk about Bitcoin and gold. Chris had a really interesting kind of synopsis on this. He mentioned that if you didn't look at any other asset price and you just looked at gold price, you would assume the economy was in a much different state than what it actually was, right? You would probably assume we had a severe bout of stagflation that we've seen historically during times when gold was in a bull run, but that's really hasn't been the case at all. So it's kind of an unusual sequence of events, and a lot of investors have been approaching us in terms of how we're just generally thinking about this clear divergence, right? If we look at the chart, we can see in 2021, 2022, Bitcoin's price got pretty heavily extended from gold's performance, and now we're seeing the exact reverse, kind of starting that regime shift starting a bit in 2025 at the beginning of the year. So what do you make of that? Is there a larger meaning to this big divergence, or do you view it as more of just an ebb and a flow of the market?
Yeah. I think, and I can give you my take. I'd be curious, what the general consensus is on the research desk side and how you guys are thinking about it. I think the first thing, maybe this is too 101 or level setting, is and most listeners probably don't need me to review it, but I always go back, why does Bitcoin have the moniker of digital gold, right? If we run with sort of the background of Bitcoin being the first crypto asset, as a result, the longest standing, it makes these trade-offs for simplicity, right? There's no smart contracts on the base layer, but that's an intentional design. You argue it has the greatest degree of decentralization amongst all of these digital assets of anything, sort of any piece of software. And then that it's monetary policy, which is sort of core to the network's identity, which is this predetermined disinflationary supply schedule that halves every 4 years, like we sort of just talked about, is perceived by most to be this scarce asset, and that's core to precious metals, particularly gold, that have these high stock to flow ratios, high rates of scarcity, and became monetary metals that are held by governments, central banks, individuals, and similar to gold, Bitcoin has the characteristic of it being a non-sovereign asset. So the thesis makes sense, But I think in actuality, if you sort of look at the data in terms of, okay, well, has Bitcoin traded like gold? It ebbs and flows. Like Bitcoin has had these various periods of time where it's correlated to gold, or where it's like different assets it sort of correlates to. And that, I guess you could argue, is like the true sense of being like an alternative asset, is you correlate with things sometimes and you don't other times, and it's around zero roughly in terms of correlation to anything. And then that can be sort of this rebalancing capital inside of a portfolio. The problem is right now, obviously, Bitcoin's gone down in price. Gold has ran up in price. But I think the argument I would make is that, like, other than a few brief stints in time, there hasn't been a super strong correlation to gold. And so people haven't really traded it like gold, or at least there's no evidence that they have. And in fact, I think they've traded it more and more like software stocks, like non-profitable technology. I think we've seen a lot of these, like IGV is just like, because it's the largest software ETF, a lot of people have been drawing like charts together of IGV and Bitcoin, and been like, this is essentially the same chart. Bitcoin, you're trading a software stocks basically. And like in the current environment with AI causing everybody to have fear about like terminal cash flows of software stocks, you've not wanted to be correlated to software stocks recently. And so I think the reality is just that Bitcoin has continued to trade like a risk asset. And so, like, as much as we want to say that it is digital gold, and people, probably long-term holders, are continuing to buy it because they believe that it is this asset that can't be printed, and there's more and more evidence that monetary and fiscal policymakers will put more liquidity into the system because they kind of have to, because there's too much global sovereign debt. And so over time, people will continue to hopefully realize it for that. But the reality is, in the short term, it continues to trade as an asset in the furthest out risk bucket. And so therefore, if we're in a risk off environment, Bitcoin will probably continue to be treated as such. That's like the main thing to me of like why we're seeing this decoupling. The other piece that's like kind of idiosyncratic to gold, I think, has to do with like an East versus West dynamic. So like if you look at China, the PBOC has been adding like a pretty significant amount of liquidity to markets. They've been like very supportive, injecting liquidity via reverse repo facilities, other lending facilities, to counteract sort of like weaker consumption, a sluggish property sector in China. You can see it in the Shanghai Composite Index up. I looked before this, 22% over the past year. And remember that crypto's banned in China, and they've actually even like tried to tighten the screws at the start of 2026. Gold is of course not banned, and so I think there is this dynamic of you have quite supportive PBOC in China, people looking for an outlet. And it seems to be that precious metals are one of those outlets. And then conversely, in the US, where the stance around crypto has gotten more friendly from a regulatory perspective, I would argue the Fed is like, of course, starting to shift from this like hawkish stance, worried about inflation, to more like moderately dovish stance. But there's still like consistent hawkish messaging. Maybe that will change with a potentially new Fed chair mid-year. And then we've also had on the fiscal side a buildup in the TGA, the Treasury's checking account, which is like extractive of liquidity if there's just more money sitting in a checking account versus being spent out into the economy. So there are some dynamics in the US that maybe are less conducive to liquidity, and more conducive in the East, in China, where they can't buy crypto and the rules are against crypto. And so there is a little bit of this like tug of war to some degree. So yeah, that's sort of how I'm thinking about it, a little bit of some of this divergence. Maybe I'm just like coping with the fact that gold is getting bid and Bitcoin has all these properties of gold and it should be getting bid. But to me, that's the way I'm kind of thinking about it.
Yes, we don't blame you for coping. I mean, I think you do a really good job at explaining the fact that even though it is a global system, there's going to be some nuance in terms of like which region's liquidity picture might impact the asset different from the others. And I think like we've already seen that central banks, bidding gold has been a big narrative. And then maybe even people like retail from the East might be, jumping on that train instead of, the digital asset version. So I think completely agree. I think there's a clear silver lining here personally. But you
Yeah,
can go ahead.
sorry, don't mean to interrupt, but you make a good point. Is central banks seemingly buying gold, and like the reality is Bitcoin is just still too small, right? It's I think today sub $2 trillion asset. I haven't looked at the market cap recently, but I think at current prices, you're under 2 trillion. Gold, again, haven't looked relative to current prices, but 40, 50 trillion. And so just the ability to move large amounts of capital, if people want to move, away from treasuries, which seems to be, sort of to some degree what we're seeing globally is central banks looking towards neutral assets. But gold is like the largest, most liquid neutral asset that they can move to. And it's just not practical. There's not, as much as like some of these smaller central banks will buy a bit of Bitcoin, like that's still largely on the fringes. And, these large, G7 central banks are not, they're just the reality is it's not a large enough asset today. And so Bitcoin can't be responsive to that from central banks. It largely has to be individuals that are making investments from today's market cap, feels like.
Yeah, I completely agree. I think the past year, and we can touch on it in kind of the next section of, the look ahead where Martha talks about kind of the financialization of Bitcoin. But I think the silver lining that I was going to mention is that, like, this clear divergence basically means that Bitcoin's correlation to gold and other assets in your typical portfolio mix is low, right? And can change over time. I think that's clearly the silver lining. And like our view, on the research side is really that both assets serve a similar purpose as a store of value. I think most people in the digital asset space would agree with that, but they express that purpose at different times, right? And I think from an institutional allocator point of view, like that's a dream come true, or as close to a free lunch as it gets, right? And when you combine that kind of low correlation, at least within the alts bucket, with the decreasing volatility that we've seen, like structurally, those are like the two ingredients that you essentially need to raise a given target allocation to like digital assets in your portfolio if you're doing some sort of like volatility targeting, or maybe are a more sophisticated asset allocator. So to me, that's the obvious silver lining that will be my cope during the bear market. Okay, we do have a question in the chat from Robert. I think it's a great question, and it jives with kind of the next topic of discussion, which is just the growth in digital asset financial products. So Jack, maybe when we discuss, we can answer Robert's question on kind of like how is the proliferation of financial products in digital assets like impacting price? Does it impact scarcity? Does it lessen that like store of value property or nature that Bitcoin and other digital assets naturally have? So I think that's a great question. Before, like, to set the stage, I really think Martha did a great job in this section of highlighting everything that we've seen over the past year. And really, to summarize the trend, it's basically digital assets integrating into traditional financial markets, right? Through ETPs, digital asset treasuries, broader exchange coverage, and like other forms of financial products. My question to you is, do you think, and this is as loaded as a question gets, Jack, but feel free to disagree. Do you think the next trend is the reverse of that, where you see traditional markets and traditional financial players entering digital assets? And what do you think is more impactful to digital assets as an asset class?
Yeah, I think I would agree 100% with that. So I think we've seen Bitcoin and Ethereum get wrapped into these exchange traded products, etc. And that sort of phase. Okay, sorry, I bumped into my microphone. Yeah, sorry. So lost my train of thought there. But yeah, phase one to me was taking these digitally native assets, making them more accessible to traditional investors. And that increased efficiency and accessibility to the asset class itself, right? Previously, you had to go completely out of your way to a crypto exchange that was isolated from traditional assets. and you had to create a separate account relationship. But that just doesn't scale for like the average person, the average allocator that wants to own 1, 2, 3% in a portfolio and be able to rebalance with their traditional assets. Now that has completely changed with the ETPs, and it feels like every broker either has started to offer a direct crypto access services or has plans to offer that through some third-party service that's white labeling to them. And I think that that's obviously a great development, in particular for like Bitcoin, where the underlying, it just is what it is, right? Bitcoin is, we already said it, it's simple, and it's trying to be this monetary alternative. But I think for the rest of digital assets, in order to justify its existence, it can't just be this circular, speculative, like all these digitally native assets that live on Ethereum that get used as collateral for loan. Like, it doesn't, to me, that doesn't make any sense. What you actually need is for real world assets to gain utility and benefits from existing on blockchain rails. And I think that that's all just now like starting to happen. If you look at tokenized real world assets, RWAs, we scaled, I think, 3x over the past year from it was like around 7 billion to 25, 26 billion today. I think that, this is my prediction, may or may not come true. I think that that'll scale to, 100 plus over the course of this year. I'm quite bullish on it. And what does that ultimately mean? I think it means that like assets are going to get tokenized onto blockchain rails and then potentially be able to be used on this infrastructure that's been built that thus far has largely only been helping digitally native assets. Like, it's largely like versions of wrapped Bitcoin and Ethereum and Solana that are collateral on like Aave and Morpho lending pools. That has like a supply cap that is constrained to the size of those native assets versus, if you're tokenizing all these various alternative assets that are harder to get access to, that are less transparent, all of a sudden you're making them more transparent, more accessible. You're creating robust lending markets on top of them. Well, now all of a sudden, like, the infrastructure is more useful. The traditional asset, like the tokenizers of those traditional assets, the banks and brokers today, are gaining utility from bringing assets on chain. And then the actual protocols and layer one networks are providing utility. And so there's actually like some sort of a flywheel of like sustainable, potentially, dare I say, revenue sources and asset bases that I think actually make all of this stuff start to work and translate to traditional investors. Whereas today, it exists in sort of a largely speculative form. So, long-winded way of saying, yes, I think that the next stage, which is all already starting to happen and the seeds are being sowed, and potentially Clarity Act, if the banks and crypto industry can sort of come to some sort of agreement around stablecoin interest payments, seems like that's sort of the last hiccup. We can get some more clarity in terms of regulation around being able to tokenize assets on chain and whether some of these tokens are securities or not. I think that goes a long way for these large regulated financial institutions to continue to be able to sort of make their way on chain, so to speak.
Yeah, no, Jack, I mean, I think so. From the data, we can see that a lot of the on-chain activity is kind of centered around like speculation or going max long the native asset, right, of any given blockchain, right? And well, I think, like you mentioned, it kind of doesn't make sense. I think it, like, there's room for speculation, and I think the issue that maybe we're highlighting here is that revenue associated with that is like often very cyclical, right? And it's very difficult to maintain, and it's often quite a competitive market in and of itself. And I think, in my view, like my simplistic view here, is that really traditional markets are just much larger, and you mentioned that before. So in my view, like this secondary trend that hopefully we'll see play out. I don't know if you have a thoughts on time frame, but I think this kind of reversal where traditional financial markets making their way on chain just, is clearly a bigger wave than previously what we saw in 2025, even though that seemed like, there was headlines every week about some sort supporting this type of trend. The only counterpoint, like if I were to play devil's advocate there, is that like, since it's a bigger wave, it's probably going to take a lot longer to fully play out than this trend we've seen really happen over the past like 1 to 2 years, which was basically just like wrapping digital assets in a number of like financial products that TradFi is already very familiar with.
Yeah. Yeah, 100%.
Cool. Just looking at let's see some of the questions here. Okay, we can touch on these momentarily. We can touch on AI and some of the miners in a bit. And okay, really good questions. I appreciate you guys sending those in. Jack, I'm gonna head over to my section, which I think personally you are the ideal guest to opine on. And it's really like, this is a really nascent space, but I think it's really important for our investors to at least understand what's going on. So my section of the look ahead was about token holder rights. And it's really the main takeaway is that, like, for a number of reasons, in my opinion, investors have been like correct to either be very cautious or not participate in like the token space at all, right? And we can get into like what those reasons are, but I think that was like a very rational thing for many investors that aren't extremely sophisticated to do. But what I'm seeing now is there are a number of trends picking up in popularity that might actually warrant some investors to like take a second look at the space, right? And just for our listeners, when I refer to the token, it's really the on-chain business or the application that I'm referring to, as opposed to like the digital asset infrastructure, like the underlying blockchain, like Ethereum or Solana. When I refer to tokens, I'm really referring to the business built on top of these layer ones, like Ethereum and Solana. So Jack, I mean, the first trend that we've seen pick up is really buybacks. I mean, this is probably catches the most headlines out of all the buckets that I've mentioned. And I mean, just give me some raw thoughts. Do we think buybacks are going to be like an industry standard? It kind of seems like that's almost the trend, right? Like that's kind of the cool thing to do as a token or an on-chain business. And you can understand why, right? Like token holders are typically going to reward those that, return capital in some form or fashion. But I'm curious if there's any more nuance you'd add to that.
Yeah, you said it best, right? At the end of the day, these are essentially distributed software businesses that operate with very high margins for those that actually are able to monetize their asset base. So for me, like we say, like tokens aren't a replacement. Are effectively like aren't a replacement for the fact that like this business has to have some sort of fundamentals that underlie it. Granted, if it's earlier stage, like the abstract, the fundamentals may be a little bit more abstract. You may have to like kind of extrapolate out what that looks like in the future if you're starting from pre-seed seed and just an idea. But you have to envision that there will be some sort of, whether a lot of these things are financial in nature. So some sort of monetizable asset base of users that are depositing or trading. And, there can be some sort of net interest margin on deposits, or there can be fees associated with transactional activity that creates a revenue source that you could sort of project out into the future based off of certain assumptions. And I think like the fact that there's a token isn't a replacement for that. I think it's a little bit less clear in terms of like what the best practices are, and we're still in this like very early stage. So what I've actually seen over the past like really like 6 to 12 months, especially when you look at these earlier stage projects, is to me the like smartest approach has been to reserve maximum flexibility. So if you're a project that hasn't launched your token yet in the current market environment, why it's not conducive to necessarily launch it, because then once you launch it, you're sort of set in stone with the allocations you make. Like the approach to launching tokens before was like, 30% of token supply is just going to be earmarked for airdrops for like community. And now people are looking at it like, well, what was the ROI on that? Because it's sort of like what you're doing is you're like pre-funding future expenses and capitalizing it up front by like baking it into this allocation of tokens of the treasury that will fund this DAO, of the community airdrop, etc., of liquidity for like market makers. And nobody stopped to ask the question of like, well, does all this allocation actually make sense, or are we just doing it because everybody's been doing it? And like these tokens have only existed by and large for like the last 5 years. So like we don't have enough evidence to say that like this is a good or bad use of capital. I think we're starting to have some evidence that like we should probably rethink some of these things.
Yeah.
And then on the buyback piece, again, it points back to like the market is still so immature. It's really hard to say if there's like sophisticated allocators. I don't think there are today currently sophisticated allocators that are looking at the capital allocation practices of these DAOs and determining like if that's a good or bad use of capital. Like traditionally with a startup, you're not going to be buying back stock if you're a Series A, Series B, Series C business. Often you do the opposite. You issue more equity at a subsequent, often higher valuation of the business is doing well to fund new projects, whether that be to grow existing products, to grow new lines of products. But that being said, like there are worse uses of capital because a buyback is effectively a return of capital. And like you could argue for some of these projects, like I think there's sort of a handful of projects that in the DeFi space today, some of the more mature ones with larger asset bases that have actual revenues, some of them are doing buybacks, some of them aren't. But like you could argue that they trade at multiples relative to like traditional equity comps if you were to give them that are potentially favorable. And so maybe it's a good use of capital to be buying back tokens. But again, it's not something you would probably see from early stage traditional equity businesses. So you have to pause and ask, like, is this necessarily the right direction? Maybe not.
I personally think you bring up two like separate but like connected points. Like your first point was that, hey, a lot of these tokens and businesses launch with some sort of like maximum supply or this supply overhang, right? So like there's a bunch of tokens out there floating around that, hey, they're not exactly sure, what that's going to be used for, right? And do you view buybacks as almost like a solution to tokens that maybe have already launched with a maximum supply and potentially a pretty large supply overhang? Do you view buybacks as like a potential band-aid or like near-term solution to some of those issues?
It sort of seems that way. If you have, and also like in some of these cases, this is a problem too. There aren't like industry standards around, well, what is the market cap of that token? We usually use fully diluted value, but then like, okay, is that accounting for the fact that they have been doing buybacks and that a portion of this is burned? And are the buybacks actually burned, or are they now sitting in the treasury that could be reallocated again? And so like there's all of this like issued or created but not issued supply where like the you could get a very different market cap if you were like sophisticated and looking at what's actually out there and circulating and dilutive and what's not dilutive. It's confusing, and over time I think we'll solve for this, but we haven't yet. And so it just points back to like it's just still such an early stage. I mean, I guess the most important thing here is like these things I think will eventually get sorted out. If anything, you could argue that there's maybe alpha of like information asymmetry if you have like time horizon and are sophisticated enough to sort of understand what the actual supply is, what's dilutive, what's not dilutive, and if these projects do grow and scale over the next 5 years with the growth of on-chain or off-chain assets coming on-chain, then maybe there's some pretty big opportunity here while the market sorts all of that out if these things are able to grow and scale. That's the way I sort of look at it, but of course that's me speaking, not investment advice, and I'm obviously biased and sort of bullish on this whole segment at large. But a lot of these projects are going to fail, and we sort of know that ahead of time. That's sort of the nature of the game.
Yeah. I think like going back to my kind of breakout of all the different kind of mechanisms I'm seeing, or the part of the token holder rights stack, like most of those are focused on like aligning investors with the underlying business and like providing some level of like transparency and clarity, Because that to me seems like the ultimate kind of understanding that everybody can kind of agree with is like, hey, there is no industry standard, and your typical or even your sophisticated investor is going to have a lot of time going through the thousands of different tokens out there and understanding each of their unique structures, right? So I think the benefit here and why I think it's important for investors to at least be mindful of these trends is that it does seem like there's significant uptick and demand from both the business side as well as the investors to kind of align on some like standardized structure that provides investors like enough clarity so they can make like reasonable decisions. So you don't have this largely asymmetric kind of competitive market where only a few people can really understand like which tokens are like reasonable opportunities out there.
Yeah, for sure. I mean, it's almost like regulators have thought about this before on the equity side.
Yeah,
So,
and interestingly enough, so the buyback piece is kind of like a very equity adjacent thing, but what I love so much about this trend is that it's happening organically, right? It's not it doesn't seem like we'll have to necessarily wait for regulation to seep all the way down into this kind of territory of digital assets that can be quite complex. It seems like it's happening from the bottom up, which is why I think it'll be a trend that like, you often hear, various advisors or institutional clients like often just waiting until the regulatory picture is clear. I'm saying, here potentially the argument is that like opportunity for that clarity might arise even before we get that regulation. So it's kind of a
yeah, and
unique situation.
there are different reporting standards that are starting to be stood up by various companies across the space, and there's a lot of projects that are sort of willingly adopting into said standards to whether it be like provide transparency around token vesting schedules and
Yep.
tokenomics and various mechanics that like even from our seat on the venture side, like it's hard to get access to the information to fully understand everything that's going on. So for the average person, it's, effectively impossible in some cases. But again, I think this all relates back to like, it seems like a lot of these projects want to sort of do the right thing and they want to allocate capital appropriately and in the best interest of these token holders. So like the signs are there. It's just like, it's going to take some time to sort everything out and to figure out what the best practices are, etc.
Awesome. I'm seeing a couple questions on AI, Jack. We can't go an hour without talking about AI. Okay, this question in particular here has to do actually specifically with the research that Zach has done and his section in the look ahead. So if you're interested in the intersection of in this case Bitcoin miners and AI, definitely can check out Zach's part of the look ahead. But the question here reads like, what are our views on the miners kind of shifting their priorities to AI, right? And that's obviously been a big story over the past year. And like, what does that mean for the future of Bitcoin, the network? What other impacts, might we see going forward? And Zach's section actually in the look ahead made a bit of a prediction that it's very possible, given that some of the largest miners out there are actually just completely shifting their priority to high performance computing and AI, we could just see hash rate level off or even drop to some extent. So that was his take, and I think it's quite reasonable. Jack, what are your thoughts there?
Yeah, it makes sense. I mean, I was just pulling up the Bitcoin hash rate chart and like down a little bit over
It
the
never
past.
goes down, so I thought it was rather hot take from Zach, right?
Yeah.
Yeah.
I I mean, I think it's just rational. There's a supply shortage of approved um, power for these AI data centers, and all these Bitcoin miners have contracts in place and the ability to use that energy for what they want to, and they're repurposing it into a space that at the moment is paying them more for it. But that's not to say that if the Bitcoin price changed materially, maybe there's an incentive to swing back the other way. Not predicting that, but I think it's just rational, and I don't think that it's like some huge existential threat to the Bitcoin network. Like, I don't think that we're going to see this chart fall 95%. I still think, that there's some degree of stability here, but for some of these larger Bitcoin miners, it's just a trend that probably will continue so long as the demand for AI compute continues.
Yeah, that makes sense. And I mean, the nuance is that, in my view, like the ASICs are still there, right? They still have the ASICs. They could certainly sell them as a business, but they're going somewhere and they're likely to be plugged in, right? And that's the lesson we kind of learned with I think it was in 2021 when China banned mining, right? At the time, there was a majority of hash rate in China, and hash rate fell off a cliff, but it took
Because
a
they were just
V-shaped
shipping them
recovery.
elsewhere.
They shipped them wherever they could find like a reasonable like power situation or contract, and I think that's like very reasonable, right? If you look at these Bitcoin miners turning into like hyperscaler leases or what have you, there's like they have many different sites and they're all maybe like they have their own quirks, right? Maybe some of the miners have a couple like really large locations that are like optimal for a data center, but then they might have some smaller locations where basically the business decision after that, after securing like an AI contract, would be like, hey, how many ASICs can we fit in all of our other sites like while we build this out, right? So it's not kind of everything unplugging at one time. It's kind of seeing what you can do as what's the best business decision as both a Bitcoin miner and an AI data center locale to make as much money as you can. And like I said, we all know that ASICs can just be plugged in wherever is available. So that's my take. Let's see. Do you have any other thoughts generally on the intersection of AI and crypto? Obviously, Zach and we just covered the Bitcoin mining side.
Yeah.
Is there anything else that comes to mind? I'm sure it's a bit hazy, this intersection, for a lot of our clients. What are your thoughts there?
It is. I mean, we're definitely like exploring the space. There's a lot of like reason to believe that principles from crypto would be useful in AI, particularly around like privacy as well as like transparency of how these models are being created and how they're storing information. But like at this point in time, I think that there's a lot of projects working on these things, but at the same time, the adoption has happened from these centralized AI companies. There is a question here on sort of the growth of stablecoins and the implication for AI agents. Again, still like early and abstract, but I do think that stablecoins on these, in particular, like as block space has become abundant, and we have these stablecoin specific layer one blockchains that are really still in their infancy, but basically making it such that like you could send stablecoins for next to nothing. Or I think Circle made an announcement today around these like ability to make micropayments for AI agents. I think there's definitely something there. If we're going to live in this world where there's all these different specialized agents that are communicating with each other and fulfilling tasks, on this like automated basis, they have to be able to like transact and send currency, and like the existing financial system's not scalable to be able to do that, and like have the micro transaction not cost as much as the actual transaction. And I think stablecoins in this infrastructure solves for that, but exactly what that looks like is still, it's still TBD.
As
But
well as the
everybody in this,
timing, right? I'm
yeah,
no AI specialist or researcher, but like most of the people I know aren't running AI agents. Their businesses aren't running AI agents that are sending these payments around the world. So while it's like a reasonable story and I could see it happening, and the value of like why AI agents would, may prefer stablecoins in the future, I don't know what the time frame looks like, right? Like as an investor, that's a really hard kind of trend to fit into one kind of time frame that's like investable in any sort of way. What I personally think is kind of underappreciated or like not talked about at all, and a very near term impact, is just the thousands of crypto developers becoming however many times more productive because of AI. In my brain, Ethereum, Solana, applications on top of these smart contract platforms derive their value directly from developers, right? Their utility value is essentially like, hey, how many people are using this? How much utility does it provide like the rest of the world as a network, as an application, etc.? So if you make the thousands of crypto developers just like marginally more productive, to me that, as long as they're not all creating meme coins with this new productivity, that like seems to translate into like a direct step function in value for these like smart contract platforms in particular.
Yeah.
Cool. We have a number of questions. We have Maya Appleton behind the dish today helping us out. I don't know if Maya, you had time to look through all the questions and see what's on our on our listeners' minds today.
Hey Max, hey Jack. Yes, we have a couple questions that would be awesome to get through in the next 10 minutes. The first one being, where do you see the most durable value being created in digital assets over the next few years? Do you think it's more at the protocol level and infrastructure and applications, or in the financial services side?
It's a great question.
That's a great question. We can go back to my slide here. So I didn't go through kind of the trend that I was seeing. Just give me one moment. And it's hard to, like, when you use the word value, like I'm looking at like essentially cash flow value, but we all know within digital assets, there's, additional, values above and beyond like what users are paying for. But when we look at the data and what we can see this trend pretty clearly actually. And the trend is essentially a majority or larger portion of all the dollars that digital asset users spend is flowing to applications. Okay, so this chart, which I didn't explain before, is really just a revenue of like a handful of applications. So businesses on top of ETH and Solana and their revenue, right, over time. And we can see in 2021, the application revenue was pretty low, even though usage, like general usage of the chains, was high, right? And that's because the majority of like the dollar that every user spent was going to the underlying digital asset infrastructure, like the layer ones in this case. And now that's changed due to the success of scaling. The efficiency of these blockchains has gotten better. And now more and more of that user's dollar is actually making its way to the applications. So that's, I think, a big trend that we've identified. And I think it will continue, right? And the idea we talked about is what the companies are then doing with that revenue. And a lot of them are turning towards just using some of that excess cash and buying back their tokens. So I thank you for closing the loop. Jack, I don't know if you have thoughts here
Yeah.
personally.
Yeah, no, a lot.
Yeah.
It's like, to me, on the, because I think of Bitcoin in its own bucket and then
Yeah.
everything else. And like on everything else, this is like one of the key questions is it at the application layer or is it at the protocol layer? I think at the protocol layer, there's another key question, which is, are these things supposed to be priced off of cash flows, or are they supposed to be priced as also like part revenue generating business, part it's this, it's a secure network for holding all of this value, and we should value it based off of the fact that all of these assets are now being tokenized. Like, let's just use Ethereum as the basis. Like, does it matter how much your staked ETH can earn, and we should discount that yield and build a DCF off of that? Like, we've tried to do all that stuff, right? We did it on the research team, and like, I don't know if you've updated it, but like, you have to have pretty aggressive assumptions. And the trend also has been, there's more competition for block space. We're seeing more blockchains. Like, we're seeing more evidence that we'll continue to see this fee compression to make these microtransactions feasible on these networks. So I think that's a harder bucket to me to look at and say we can value this based on cash flows. I think you kind of have to believe that they'll be valued based off of like almost as these like network states, and there will be potentially a handful of them that are immensely valuable, potentially the ones that are already valuable that have the network effects, Ethereum, Solana, etc. And as more assets get tokenized on chain, the value of everything sitting on top of it is worth more, and therefore like they become more valuable in that sense. So it's kind of a different valuation framework than just saying this is a business that we discount the cash flows, because it's really hard to get there based off of an analysis of cash flows. On the application layer, I think it's a lot more straightforward. When you own the user, when you're these large, robust, like to me, there's, again, just from the way I look at it, there's 10, 15, 20 potentially of these like DeFi tokens today that I look at and I'm like, that actually looks like a business. They have, X billion dollars of assets that are sitting there. Some of them are monetizing, some of them aren't. All that to say, and they trade at what looks like, a reasonable valuation. Again, like, not investment advice, just the way that I'm sort of looking at it. You actually can look at it and it kind of looks like a traditional business that you can value. And so it seems like there's opportunity there. I think the thing that you have to believe is that current earnings, like if you look at the last 12 months and you kind of back out, whether you look at top line revenue or you back out to an earnings number or some sort of estimate of what you think is like kind of earnings that's owned by the company. Again, we talked about it's not transparent, it's like who owns what, etc. But if you believe that they're monetizing these asset bases, or they will, I think you also have to believe that they're not at a cyclical peak in earnings, and that all these assets are starting to be tokenized, and there will be more activity from RWA assets on chain. To me, that's the story that you kind of have to believe to get excited about the application layer, particularly within DeFi, of course.
Yeah, and the timing here, I think, of this discussion and the look ahead in general to be discussing this is perfect. Obviously, there's still like some headway to be made, or maybe still like some leftover to-dos on the list of like the previous trend we talked about, which is digital assets integrating into traditional financial services. But I think the 2026 and beyond is really the focus is going to be the reverse, and I'm definitely excited. So like I'm personally a believer in that, and you've got my thoughts, Jack. Seems like it would be a shame not to answer kind of one of the last questions that I'm seeing here. And it's around like the private wealth landscape, just like evolving with blockchain rails. Like I've got a lot of clients, advisors, kind of maybe using Fidelity for like some of their traditional financial services, and really just curious how they're going to be impacted by tokenization, just the increased use of digital asset rails for a number of financial services. Do you have thoughts? Like,
Yeah.
yeah,
I mean, the way I think about it is probably like twofold. One is, I think, and it's going to continue to take a while, but we'll have these gradual improvements of the underlying operating systems that your broker dealer or bank operates on, where all of a sudden we go from sending a wire on behalf of a client and then hoping it gets there before the close of the day, or you have to wait the entire weekend for it to get there on Monday, to 24/7, or they'll operate closer to whatever it is, 23/5, at least materially better. And then eventually to these, like, you reduce the friction of the operating system that assets sit on. And it started to happen with stablecoins, and you're seeing it with like Visa, MasterCard, PayPal. Like the largest payments companies are making investments both in their own like employees and businesses that are building out products, and in the individual companies that are like actually able to operate even at a speed faster, and integrating those into their existing stack. And so like on tokenized money, that seems like it's like really the first, and we've spent a lot of time investing in the space on the stablecoin front. That's sort of like iteration one, tokenized dollars. And then from there, as that starts to get integrated into traditional financial service sort of lineups, we're also starting to now see tokenized other assets. And so one, that will improve like the existing asset lineup and like the functionality and ability to like, whether it be, automated real-time rebalancing and or 24/7 markets, whether you want it or not, are like already starting to happen. You can see it on like Hyperliquid, where people are trading oil on the weekend, and we're like seeing the Wall Street Journal like imply what the price of oil will be at open on like a Saturday or a Sunday, when normally they have to wait until 6 or 7 o'clock on Sunday night to be able to tell you what the implications are for the price of oil from what happened over the weekend. All that stuff, like the feedback loops are getting shorter. And again, whether you want it or not, it's like frictionless markets are going to continue to evolve. It might take time for the large incumbents to fully adopt all this stuff, but they're starting to do it with a lot of these things. So stablecoins, tokenized assets, all coming. And then I also think the other piece is like accessibility to new and emerging assets that are like underutilized and under-resourced. So like new sets of alternatives that find their way on chain. Like we're seeing like all these interesting, like I see like reinsurance companies that are bringing these uncorrelated alternatives of reinsurance on chain. And it's like, well, could you access that? Maybe, but you had to go through a bunch of hoops to get access to it, really go out of your way. Now, all of a sudden, it's available on chain. It's transparent. That's just like one example, but we're starting to see that where like different asset classes that will be more easily available. And then also like idle capital could become, capital in motion a lot easier and still be like quite accessible. So I think there's a lot of different marginal improvements that are all sort of happening at once, but hopefully a lot of that will sort of happen for users rather than them having to like overcome inertia and go open new accounts at new places. I think a lot of it's happening. It's just regulations have to continue to sort of evolve and allow those products to be offered, and the pipes have to be built to offer them.
Very well said. That's definitely our goal at FTA, to approach it that way. It seems like we're at time, Jack. This was an absolute pleasure as always. Sure hope we can have you back soon. Really glad our clients got your insights and you were able to add a bit of your own look ahead today. If you have any questions, you can, or you want to check out the report, go to fidelitydigitalassets.com. You can follow us on socials, etc. So thank you so much, everyone, for joining. And Jack, thank you again. Have a good one.
It was a pleasure. Thanks, Max.
Thanks.